Have a good afternoon, and it's a good afternoon if you're a bear, because if you're a bull, it's not a great way to probably acknowledge and see what's happening in the market, because it's a deep red across the board. Yes, the Nifty is down below the 22,000 mark, but there are deeper cuts when it comes to the broader market. The small cap index has eroded 5 percentage points in a matter of a day, and that's of course the biggest single session decline that we have seen at least in the last 4 to 5 months. The small cap index also is coming under pressure. The advanced decline ratio is really bleak right now. India VIX has surged. So the opposite of Goldilocks scenario happening right now. Murphy's law at play. Whatever wrong has to happen has been happening, and market is not willing to buy any good news at this point of time. There's no recovery on dips at all. Clearly, the word is carnage, the word is capitulation. At least that is how it's working out right now, guys.
Oh yeah, absolutely. And to think of it, we've only fallen 10% on the small cap index. Even in the best of bull markets, we've seen much steeper corrections, and the mid cap index is still holding on to its key DMAs. Of course, we'll have a battery of experts over the next half an hour and try and decode what this sell-off really means and what investors should be doing to try and wade through this volatility. We'll have Kunal Bothra, Nooresh Merani, Sunil Subramaniam join in on the show, and we'll also have Ankit Kanodia from Smart Sync Services to try and analyze really what is it that you should be doing with your small cap positions right now. So let me take it across then to our experts without further ado. Sunil, hi, afternoon. Just wondering, what is it that you're making of this small cap capitulation finally? Your smile tells me that you've already made the switch to large caps.
I think it's basically driven partly by the regulator driving through AMFI, the need for each fund house to review their mid and small cap funds, both from a portfolio liquidity perspective as well as taking care of the small retail investor. So if you want to protect the investors already there, they're saying please moderate the inflows if you feel fit, raise necessary liquidity to protect, and make sure that you have enough to meet any large redemptions if any institutional or big ticket investors do put in a redemption. So I think what's happened since then, you've seen some fund houses have introduced kind of moderation in the flows, stopping lump sums, limiting SIPs. At the same time, at the back end, each small cap and mid cap fund, as you know, the SEBI rule says 65% has to be in mid caps and a mid cap fund and 65% in small caps. But many fund houses had two things. One is, instead of 65, they had probably 75, 80% in the small cap or the mid cap. So that's one, which would narrow down the liquidity because the balance has to be either cash or large caps. So naturally, they would be selling a little bit of the excess over 85, 65% small caps and mid caps in the respective funds, and creating that liquidity either through cash or through a highly liquid large cap. That's number one. Number two is the fact that many fund houses, because they had been worried about these rise in valuations, had expanded their portfolios. So there are some funds which have in excess of 150 stocks in their small cap funds, for example. So then you are looking at it saying from a potential perspective, and if you already have a very large SIP book running, as you know, SIPs have gone up from 12,000 crores at the beginning of this financial to 19,000 crores, and more than 50% of the increase has come from small and mid cap funds. So those fund houses which are getting these SIPs are aware that every month on month they'll be getting flows into these. Now, is there room if they've already crossed 150 stocks to go and deploy it? So naturally, then they have to take a pause and say, we'll stop fresh inflows. At the same time, given the fact that as a correction like this happens, you might see large ticket investors try to cut their losses or book profits, because obviously everybody has made money in the small cap and mid cap funds. So when that happens, you need to have adequate liquidity. And if you sell only your large caps when a redemption comes, then again your concentration of the portfolio increases. So you'll have to sell a little bit of your small caps, a little bit of your mid caps and some large caps to meet those potential redemptions. So this SEBI guideline, which came in through AMFI, basically asked the boards of each AMC to review their respective small and mid cap funds from a unit holder protection perspective and institute all these measures. So probably various fund houses are going and presenting. There was a 21-day timeline, and they are then studying it. And maybe the board will feel, the fund manager may feel I can take more money. Right. But the board may say, in the event there is a sell-off, want you to take more liquidity in your fund. So these are a combination of factors which would have led.
Sunil, we'll come back to you in a minute because Sundaram, specializes in small cap, mid cap for a very long time, and you understand the nature of that asset class very well. But let's get in some other factors as well. Ankit Kanodia, founder and partner at SmartSync, is also here. Ankit, afternoon to you as well. So, it might be, looking very jarring, the screen right now, given the, entire screen is painted with one red. But we all knew what is coming, right? A lot of fund houses, fund managers, individual PMS guys have been shouting from rooftops last few months that mid cap, small caps are trading way higher than their long term averages. Earnings are not keeping in the same pace. The stocks in a short period of time have gone up many times. They historically trade at a discount to large cap, but that was so we all knew who were overstaying in this party, right? So now from here on, what should the approach be? If I am an individual portfolio, Aisha spoke about how the index is down 10% from top, the small cap index, but individual portfolios are down 30-40%. What should the approach be now? Should one be holding on still? Is it time to start nibbling in gradually? What are you advising to your clients?
Sure. First of all, thank you for so much for having me here. I'll just start with something which we believe in our company, SmartSync Services, where we say that we don't predict, we prepare. So while everybody was saying that the correction is due, but nobody knows when that correction is. And even when we are seeing a 5% downtick in the small cap index, we still don't know how close we are to the bottom. And I think that is a futile discussion to make when the bottom is being made or how close we are to the bottom, right? I'll try to take a longer term view and I'll share some data. In April 2003, BSE small cap index was at 885 points only. In the next 5 years, it climbed from 885 to 12,700. That is 14x in the index. And there were many small cap, mid cap stocks which had 50x, 70x, or even 100x returns. Now, when you come back to the current cycle, if you see the March 2020 small cap index bottom was made at somewhere around 9,500 level. And from there, we have had a journey till 46,000 roundabout. So that is again 5x. And at this kind of a huge base, this 5x is also a very good returns over a short period of 3 to 4 years, right? So the correction anyways was expected, will come. Nobody can time it when it is going to come and how deep the correction would be. Second point, so this is what the nature of small cap is. So even if you talk about the correction from 14x top, it corrected 75% in 2008-9. And again in 2010, it was back to close to its high, right? So these things will keep on happening. What we need to understand is that if you look at the last time when we had a very difficult time in the small cap space, 2018 to 2020, where the whole small cap and mid cap space was having a very tough time, you should understand that at that time, even then, 2 years is when the market recovered, right? Of course, it was a very, very, very difficult time. Those 2 years was not a short period of time. But at that time, Indian economy was going through a lot of pain. And prior to that 2013 to 17 bull run in the small cap and mid cap space was more of a hope rally. Today, when you see the market has also become more and more mature. There are so many companies which are there in the universe. So for the sake of understanding from SEBI's calculation, 20,000 market cap company is also a small cap today.
Yeah.
That is how mature the market is today, right?
Correct. No, yeah, the definitions have matured and the overall, system has matured as well. The basket has become large, but maybe it's only a few names out of that entire basket which are getting the inflows, and that's what the regulator is worried about. We will play out the commentary from SEBI, CEA, as well as what Mr. Uday Kotak had to say, and most recently the NSE MD and CEO as well. But that in a while. First up, let's take a technical check as well as to what's happening with the mid cap and the small cap indices. Kunal has spotted some interesting things for us, so let's go across to him and figure that out. Hi, Kunal.
Hi, thank you so much for that, Nisha. So, this is the charts which I mapped are the mid cap index and the small cap index for the Nifty, on the NSE side. And the three lines which is very, very important for a trader perspective, the blue line is the 50-day moving average, the brown is the 100-day moving average, and the lower one is the 200-day moving average. Now, what we need to see is historically in the last 1 year or so, there have been multiple times when the indices have gone through a phase of correction. The more recent one was, if you remember, in the month of October 2023, when the mid cap index and the small cap index, both of them, they corrected. They came back towards their respective 100-day moving average, spent a couple of days over here, and then from a process over here, what started off was a strong period of bounce for the mid cap index. Now, if you look at the recent charts also, the mid cap index in the last 1 month, initially there was a very minor bit of a correction. It managed to hold on to the 50-day moving average, but just today the index has managed to break below the 50 DMA, which means that the next support for the mid cap index is closer to this 100-day moving average, which means there could be a potential another 500 to 600 point correction at least in the mid cap index before it retests the first strong important support point. Now we come back to the small cap index, which is again a very interesting perspective, because the small cap index last time around did not retrace exactly at its 100-day moving average. It managed to form a bottom slightly higher. So it's going through a mean reversion right now. The worst in terms of the near-term correction, which I would probably anticipate, is in case if the mid-cap index or the small-cap index comes closer to the 200-day moving average, which is currently at 13,300, 350 levels. So these are the two important levels to map out for a technical trader, because the mid-cap index and the small-cap index so far are showing a bit of divergence in terms of trends for themselves.
Absolutely. Nooresh, tell me, what are the trends that you're reading right now? The kind of shorts there may be in the system. I mean, do you get a sense that people are just throwing in the towel when it comes to small and mid-cap positions in particular?
So yeah, we are down 13% on the BSE small cap index. So the intensity is pretty fast. And what happens is, this is generally what we've seen when the breakdown happens. It continues to surprise on the downside. But you got to remember, similarly, last year when we were in March, we had corrected quite a bit from, say, the tops of January, around again 15-20%. And nobody expected in March 23 that March FY24 could be the most interesting and a clean uptick. So for now, we are back to almost the prices where we were in December. The whole frothiness which was there, the BSE small cap outperforming the Nifty, is now almost over. So the ratio which we used to look at had gone up to 2.3, which generally used to top around 2.1. We are back to 1.8, 1.85. Closer to 1.7, it normalizes that the market is in a normal stage. So overall, the view is at current levels, the risk reward is now shifting to again deploying cash into the small caps. This could continue. There could be volatility over the next 2 weeks given March end pressures, but at a 20%, 15 to 20% drop from the top, it should be a good zone to actually look at small caps. Because one more thing what we have stopped noticing is the fact that globally nothing has happened. So if you look at it today, right now, global markets are not doing anything. There was a time where we used to actually track Dow Jones if Nifty were to crack 300, 400 points. We are not seeing any downticks globally. You are not seeing a lot of parameters globally change as such. So for example, one of the parameters we look out for, copper, is actually breaking out on a 3-month chart. So overall, globally, nothing has happened. This is a situation which is where we were overbought across the board. There was over participation that is normalizing. So my view is over the next 2 weeks is actually a time to deploy cash.
Okay, we'll take a short break on that note. When we are back, we'll speak with Sunil about how the valuations of, they run one of the largest small cap, mid cap schemes for the longest period of time, mind you. That's why we have Sunil today on the show. Sunil, when we come back, we'll speak to you about how valuations of your schemes are running and the feedback you're getting about earnings visibility of some of the company which you guys are holding in those schemes when we return. The point I wanted to take forward with you was the earnings quality. The only solace one can get from this kind of a market, if already running an individual portfolio or maybe have a large exposure to small cap, mid cap, is what is the taking stock of the earning situation. We are just wound up the third quarter earnings season. How is the picture looking? Was the quality good of the universe you guys track at your mid cap or the small cap funds?
In fact, the earnings was the best for the small cap set, and then the mid cap, and then the large caps. And they were almost double the earnings growth of the large caps. So definitely the domestic economic growth is translating into a higher. These companies are highly operating and financially leveraged, remember, small and mid caps. So when there's an economic uptick, right, their bottom lines grow much faster than their top lines. So we are seeing that impact play through. And overall, I would say that we are quite happy with the quality of the earnings at the mid cap and small cap related to the large cap. So not at all an issue.
Okay, so that's the take coming in as far as the pressure on the markets right now. But do remember the pressure is actually increasing as we speak. So the weakness in the small cap index is actually now percolating to the frontline index as well. Almost a 2% cut coming in, and there's a threat that we'll go below the mark of 21,900 now. So 22,000 was broken very swiftly, and from there has been no recovery in sight. In fact, we are now headed just around the 21,900 mark for the index, and there's a bit of a vertical slide is what we are seeing in the last few minutes as well. And the kind of capitulation that we're talking about is quite visible in the advanced decline ratio. Let's pull up the advanced decline ratio, and you will see almost there are 2,000 stocks advancing for less than 100 stocks advancing. So the advanced decline ratio is a complete red circle and a red pie on the screen right now, a very small sliver of that green on the screen for you, and those are some of the individual names which are actually holding out on account of news flow, etc. But the rest of the market is down and out. Ankit, if I can come to you, what does one do with the quality mid caps and small caps that they have right now? Because there's one part which will get tempted towards maybe averaging it out as well, because those quality names do not have an individual pressure on their fundamentals. Is there a case to be made of averaging in at least select names?
Yeah, so I can't take names of the stocks, but I can talk about a few sectors. So like travel and hotel sector over the last 3 years have done phenomenally well, both operationally and also in terms of stock price performance. So that is one sector which we are very bullish on. We have select positions in some of the companies there. Then there is a sector which is not performed well in the last 1.5 year. And if you look at the current quarterly earnings call as well, so management has still of most chemical companies have guided that probably the recovery is still a little away. So in these kind of names, in some select quality chemicals, you might get really good valuation coming in. So just because a company has dropped, the share price has dropped 50% doesn't make it valuable. It all depends upon how quality the business is. So there are a few chemical businesses where the stock price correction has been really sharp, and the business quality is very good. And we believe if not 2 quarters, maybe 4 quarters down the line, recovery can be expected there. So I'm giving you two different spectrum. One spectrum where the sector is doing really well, and you can probably look at that. And then there is another spectrum where the sector is not doing well, but there you can get so both averaging up and averaging down over here.
But Ankit, how is it that you time it, and should you be timing it at all? You never buy the first smack of the fall, right? But having said that, in the last 7 months alone, the small cap index has fallen in the range of about 5 to 8 odd % in a time span of 12 trading sessions, at least 5 times, and still recovered from there. And we had a all-time high very, very recently.
So as I started my discussion by saying that we don't time, we don't predict, we prepare. So you have to be a diversified. There are people or investors who are completely small cap and mid cap focused. They will gain also in these 3-4 year period when there is a boom run. So when there is a bull run, you make so much that you can absorb a lot of correction as well. So as I mentioned that after a 14x rally, there was a 75% correction in the small cap index. But again, in the next 1 year, it was back to its previous size. So same thing we should keep in mind. There will be volatility, but nobody can predict. Like as Mr. Merani was saying that last year also something similar happened from January 2023 till March. We saw a sharp correction, and then look at the rally. Who knows? We can get the same rally again, or maybe we are going to head for a longer time correction. Rather than predicting that, focus on individual stocks, focus on individual sectors where you understand the business, understand the cyclicality of the sector, and then based on that, place your bet. And don't put all money at one go. That we have always been recommending to all our clients. We believe in doing even SIP in select stocks, and that is what we recommend everywhere.
And that mid of this month is when some of the funds will have to declare their stress test, which the regulator has spoken about. And this is the first time this will happen, and then obviously from here on, mid of every month, one has to declare the stress test. Can you tell us, Sunil, at your own place, have you initiated the stress test? What exactly would that stress test actually entail for small and mid caps?
For example, it's basically about liquidating the portfolio in the event of a sudden setback, sudden large investor pulling out. How will the fund respond to it? So in our case, we've always followed prudent. For example, in our small cap fund, we have 65 as the minimum, so around 70 to 72% is with small caps, which means that, and we have actually 20% in the large and large mid cap stocks in that fund. So there, obviously, the liquidity functions are very good. So when you test it, similarly, in our mid cap fund, we have about 65 to 70% only in mid caps. We have actually 15 to 20% in large caps. So what this means is that if there is a sudden redemption, right, we can liquidate the large caps without any price impact. And then over the next few days, restore the balance of large caps by slowly selling the mid cap or the small cap as the case may be. So essentially, the stress test reveals that if there is a sudden shock, a whiplash of some investor pulling out, how will you really have a trouble in going and selling your most appreciated small cap? Your position will be that what's gone up the most is what I'd like to sell. But market conditions will not allow you to do that. So the stress test shows that. And like I said, we've been very prudent. One of the reasons we have a very long running funds is because risk management has been a very key part of our portfolio. And I think not going overboard, whereas a fund in a small cap, he's taken 85% small caps, say, he's got only a 15% cushion. And if he has large ticket, big investors who have put in money there, then if they decide to pull out for whatever reason, booking profits, then the fund could face a challenge. So I think SEBI's purpose of doing the stress testing is intended. And so in anticipation of the stress testing, a lot of funds are now reallocating their portfolios and adding more cash or more large caps to their small cap and mid cap funds. That's part of the reason that the market is reacting, because overall as an industry, those funds which had taken much more than the minimum regulatory requirement of small cap and mid cap have to pare it down to maintain liquidity so that in the stress testing, they'll come out looking good.
That entire portfolio churn definitely might be playing a factor as well. But just let's talk about some of those outliers as well, because not everything is down and out. There is a semblance of a recovery in Kotak Mahindra Bank. That's in the green right now. ICICI Bank is just marginally in the green. So there are select pockets which have actually managed to stand better than the rest of the names. AU Small Finance Bank, for instance, is up around 1%. But bear in mind, there's only a handful of names like ITC which are actually doing quite well for itself. Nooresh, within these outliers, let's say Kotak Mahindra Bank and ICICI Bank, AU Small Finance Bank, which are the private banking names that you would recommend as a buy right now?
Private banking names, ICICI Bank remains the top favorite. The stock has held on to it. It may give a little bit of a dip. That should be an opportunity to buy. And second would be HDFC Bank. Both have started showing good amount of relative strength. So these two names, which are the two heavyweights, could actually look pretty promising from current levels. There could be a couple of percentage points dip, and that should be a buying opportunity.
Okay, on that note, we're going to take a very quick break, but don't go anywhere. We'll continue tracking markets on the other side. The last half an hour of this carnage that's currently playing out in these trades.